Hi everyone, let's get right to this. On Friday, September 5th, 2025, I took a trade. Basically, it's a put ratio spread on NVDA. NVDA has just released earnings last week, and then basically this is a weekly chart. This cause is start to sold off quite a bit. If we look at the daily, since the earnings, they've been going 1, 2, 3, 4, 5, 6 a week. They've been selling off. And we see the EMA, which is a 13, 40, in 62 days exponential moving average. It's reaching the 62 days moving average and bounce a little, which is Friday. So on back of that, I've been looking for places to actually buy more NVIDIA after the April dropped and the full recovery from April. Right, you have the April. I see a clear double bottom literally, and then just start ticking off all the way up until it basically reached my profit target for the year. Actually was around above 168 if using my DCF model, or 218 using forward cash flow models. So I didn't really get a chance to pick up any more until this drop on earnings. And this is on back of rather very interesting situations where we basically had a very low economic numbers, which the US only had 22,000 jobs in August, which is a dramatic slowdown as you see on this headline. Came out on Friday, September 5th. So the market was initially actually up in the morning. It was thinking that, okay, we're going to have an interest rate cut. But then, later on, it basically sold off. The market just basically sold off. As you can see, this is daily, and we can switch to the Dow is down 220 at the end of the day. We switch to 5-minute chart. Okay, on the open, gapped up, and it just sold right off dramatically. And then we cover a bit towards the end of the day, but still, we're still down 220 on the Dow. And this move itself helped NVIDIA. Basically, NVIDIA gapped down for the day and sold off on that. Alright, so this is an area where I decided to put an option trade on it on back of the night analysis. Now the trade itself, is a rather interesting trade because it is a put ratio spread. I sold a put ratio spread. What does that entail? Is basically I sold 145 put, which is around 42 days out. Right, so 45 days out is the ideal time. 42 days plus and minus, that's fine. So 2 of that ratio spread, and then also bought 1 put 150 strike, so 145 strike, so 2, and I bought 150. This created this type of P&L graph overall. So if the price stay about 150 right here, stay about 150, I'll make around a little bit over $100. Well, if it goes below 150, I start increasing until 145. This is a maximum gain, which is right here is 586, but this is based on the price of 162. Right? Which is the end of the day. The time I sold this put was around $600 max profit. In actuality, it was only 165 or so on the underlying prices. So basically, if we go down below 150 to 135, make money, and then when do I start losing money is around below 140, 138 or so. 138 or so. So that I will lose money. However, I actually intend to own the stock. So below that, I'll buy the stock. So I will be buying the stock a little bit around 139, which is a good price for me. Now, why is that a good price for me? It all has to go back to the calculation. Now, there's also news on why the video actually gapped down this morning. There's another piece of news is that the Broadcom AVGO is stock symbol as a new $10 billion customer, and people are guessing that, if that is the case, is this taking 10 million and billion of potential revenue from the video? So that's why it gapped down on that, while the market actually gapped up on the open. Alright, that's the stock gapped down one better than news. And as market proceed to drop, it actually slides. So that's why I get a chance to get in 165 or so around here when it bottom out and start coming back and say, okay, that's a good price for me to sell it. Alright, so now if we look at some fundamentals, okay, now if you look at earnings growth, you're looking at 56% year over year at this point, So now if you factor in let's put it this way. This year, not last year, the video's revenue is 130 billion. So if you discount 130 billion, you can calculate back down to the earning growth ratio in that sense. And with that in mind, so I did a quick calculation on that. If to use my beginning of the year numbers, okay, a 45% forward cash flow growth forecast at the price of 188 when it stopped is at 188, right? And back that out, if it's dropped to 145 or so, I still have a 30% growth rate. So that is what I calculated. Well, right, quickly, just figure out, okay, what is the growth rate, and then 30%, is that acceptable? Question is, would that be acceptable if you own the stock at 145? At that price point. If that's not acceptable growth rate for you, then you should not buy it at 145 or below. If that's acceptable, yeah, why not? To me, that's acceptable. That's why I say, okay, I will put my option trade at those price point. That's why I also determine the price strike of the option that I've sold. So, if we go back to the trade itself, right, now, that's additionally, trade itself construct is this, basically, okay? The loss will be if I'm forced to buy the stock at 139, 100 shares, so that will be 100 times 139. That's maximum loss, because if this goes to zero, of course, right? Of course, so now the capital requirement of this is 140,000. Right? I'm sorry, I'm saying yes, that will be 10 contract. Right? So it's 139 times 100. So, it's $13,000. Right? Or $14,000 to be exact. 1,3,900 to be exact. Okay. So let's put it that way. As a ways, I want to show you to mitigate the risk, so you don't require as much to open this trade. And one way to do it is you buy back another put. So let's say if I buy back another 120 puts, so you have sold 2 puts, you also buy 2 puts at this price point. Your max loss will be just $2,000 at that point. Of course, I will still buy the stock if we go below that, right? But so this trade will need a lot less capital requirement. That's what that is. Now, if you're more aggressive or less aggressive, you can buy a 90, but your loss is bigger, but your max profit is more. So it depends on what kind of profits you're looking for. If you compare the two, this is a risk reward and risk reward. Now here's the interesting thing. If you look at the win rate, potential win, it's over 90%. So you have less than 10% of this going below 140. Then which is not bad for me actually, because I want on the stock to game with. So I'm waiting for the price draw. While away, I'm getting paid basically. So that's wonderful for me. So it's a win-win for me. In that sense, this trade is 90%. I will pocket the money here. Okay, and less than 10%. Well, 10%, I will have be buying the stock, which I gotta put out now 139 times 100 shares. So $13,900 basically. If you're on the stock, and that all go back to my ECF model at the beginning of the year, where the stock at, and where I project the stock could be year end next year, and so forth. Just using I ran two model, DCF and forward cash flow basically. So when DCF at the end of the year, I mix up them 168, and if I use this forward cash flow, it's 219 the target price. It had went through, and then now it's backing off actually on this target price on NVDA. NVDA when actually, if we look at the chart, NVDA at its peak, it's peaking out at this price point 184, which is even above. So it's between the high of my TCF 168. But it's lower than 218 still, which is the forward cash flow model. So they all are projection approximation in that sense. And I certainly don't mind owning the stock at 140, which is all the way down here already. In that sense. And then if I pull back, why do I put 120 if I want to less capital intensive trade? It will be around this area, this level, before it took off again. So I'm actually on the daily, you can see clearly the red line is the 62 days EMA, and it went there. Now we can also use another AVGO analysis to enhance and look at where things are at. Is use of Fibonacci ratio. This is the weekly chart on the bottom. Basically April drop to the top high. You can see is right at about 0.236 font. So at that level, I completely doesn't mind buying it at 40 and below. And that is the logic behind. Basically, is that if we trace to those Fibonacci levels, which is this first level, well, that's where I put my strike out, and I would like to buy at 140. Of course, provide all the fundamental remains pretty much the same. So this is where I set my strike, and that's my first leg. And if we go further down to the next level, then I'll put out another leg, and then finally go to a 50% retracement, and all fundamental remains the same. I will put out my final third leg and buy the final leg of that.